Welcome to another episode of Good Value by Antipodes.
Federal officials have been working around the clock to try to find some resolution in the wake of the collapse of Silicon Valley Bank. And tonight, the Treasury Department, FDIC, and Federal Reserve all releasing a statement saying that all depositors with money at Silicon Valley Bank will be made whole. That includes the depositors.
Almost 15 years to the day that Bear Stearns collapsed, the demise of Silicon Valley Bank marked the largest bank failure since the 2008 financial crisis. Shortly after, and across the Atlantic, UBS agreed to buy Credit Suisse in a deal brokered by the Swiss government. I'm Alison Savas, and on this episode of the Good Value podcast, I'm joined by James Rodda, Antipodes Developed Markets Portfolio Manager and lead PM of the Antipodes Global SMID strategy. And we're going to look at the state of the US and Europe's banking systems, how recent events may influence central bank policy, and the risks and opportunities we see not only in global financials, but global markets more broadly. Welcome, James. It's great to have you back on the podcast. And you're on the front line, so to speak, weren't you? You were actually in Silicon Valley when the news on Silicon Valley Bank broke. So tell us about that experience.
Hi, Alison. Yep, look, very interesting period, very hectic. I was in San Mateo the day that Silicon Valley Bank went under, just meeting companies in the region. Actually, as it happened, I had walked in to meet the treasurer of a mid-sized CRM software company about half an hour before the bank was announced to be insolvent. And on walking in, I obviously asked him the question about Silicon Valley Bank, and he said, yes, they have accounts, but they've now got accounts open at other banks, and they'll be transferring money out today. So, it's not a problem. So obviously when I left that meeting, I got in the lift, and the first thing I saw was that Silicon Valley Bank was no longer. A bit of a shock, but probably not as big of a shock as what he had.
It was really quite remarkable how quickly things moved at Silicon Valley Bank. Now, before we get into the state of global financial markets, let's start by taking a closer look at how Silicon Valley Bank unraveled. Most banks do run a mismatch between the duration of their assets, which is their loans, and the duration of their liabilities, which is their deposits. But what was special about Silicon Valley Bank?
Yep, absolutely, Alison. Look, that's how banks make their money. I think the first thing to understand, though, was the difference in the concentration. So this was, let's call it, a single industry bank, and essentially a corporate bank with no retail deposits. So it was bankered to 50% of all VC-backed startups in the US. Being the core transaction banker to those companies. So it held their deposits and cash flow and cash holdings. And so what essentially happened here was the backdrop was that venture capital had raised a lot of money in the period through to 2021, at the end of 2021, and even early 2022, and that money ended up in the banking system in a low interest rate environment or a no interest rate environment, and just sort of sat in this bank, and so their deposit base swelled very quickly over that time frame leading up. And as we know, venture capital deploys their cash in companies, so you would expect that to disappear reasonably quickly as they deploy. And then also the companies they deploy to are startups by nature that essentially burn money to try to get their business going. So again, you would expect that cash to be deployed and spent very quickly. And what we saw was that as venture capital stopped raising money for new funds, it had a really big impact on Silicon Valley's deposit franchise. In terms of the concentration and the speed that I sort of mentioned in the intro, 25% of the bank's deposits, around $40 billion left in one day, and more requests followed. So, an extraordinary bank run to see that type of concentration, mainly because they all talk to each other, and the liquidity left the bank. Now, if they had that invested in liquid instruments at fair market value, no problem. The problem was that at the low levels of interest rates, when all the money flowed in, they locked in very low interest rates on mortgage-backed securities, which are essentially in the US typically a mortgage is a 30-year fixed-rate mortgage. And so they may have had all of those deposits locked in at 2.5%, and the market rate may have moved to 6%, so they were out of the money 20%. And any forced sale of the math was that forced sale of those mortgage-backed securities at market valuation, which they were not required by the regulator to represent the assets on their balance sheet at the market valuation, but sales at market valuation essentially would wipe out their equity, and that's what caused the bank run. They didn't do anything illegal. This is just purely bad management, ultra short-term, fast money being funded by or funding 30-year mortgages, the ultra long-term asset that is also a fixed-rate asset in a rising interest rate environment.
So even though Silicon Valley Bank and Signature Bank combined only account for around 1.5% of US bank deposits, so these banks weren't considered too big to fail. US policymakers stepped in very quickly. So all depositors were protected, and the Fed created a new funding program for banks to access additional liquidity to meet deposit withdrawals should they need it. So the same situation didn't arise again, the same situation that we had with Silicon Valley Bank. Now, this has stabilised the system, well, at least temporarily. What are the possible consequences of the policy response so far?
So, Silicon Valley Bank customers, I guess, with withdrawing their money was a confidence issue based on, I guess, the other side of their balance sheet. The main consequence from a behavioural issue, that we're going to see and we're already seeing and we will see more of despite, let's call it government reaction, is corporate treasurers will now seek to diversify their banking relationships. They will seek to have more of their cash sitting in insured deposits. They will move more of their deposits to large banks that have that implicit government guarantee at all times, rather than leave it at small banks. And retail deposit holders may do the same. So this basically puts pressure on banks that are, the losers on that, let's say, movement of capital to liquefy securities, to raise money to meet the deposit redemption. And as we know from the Silicon Valley Bank example, many of those securities are, mortgage-backed securities and other securities that are underwater on a mark-to-market basis. And so the Fed has come in and provided a facility called the Bank Term Funding Facility, which will lend to banks to help them fund redemptions using these securities as collateral. And importantly, it will use those securities at face value. So the idea of this is to bolster confidence, even though we don't have a full, concrete, broad-based policy response yet. It is the main policy response.
So unlike the 2008 financial crisis, where loans and asset collateral proved worthless, concerns around Silicon Valley Bank are not credit-related. But based on what we know today, what could the longer-term impacts on the US banking system be, stemming from these developments?
Yeah, look, the first one, and it's very obvious, is more regulation. So questions that arise are, will regional banks and smaller financial institutions be allowed to exclude mark-to-market valuations on their security portfolios? Will capital levels be monitored on a look-through basis, even if they were allowed to continue to not mark-to-market those types of securities? Perhaps there's a levy on the large banks as a result of this to prop up those smaller banks. banks perform well as stocks often when dividends are strong and when share buybacks are strong. And marking to market capital ratios across all the banks, even the major banks, adjusting for all their securities, including their held to maturity securities, suggests that the banks are short capital from, let's call it a safe system level. So we could see several years of cancelled or lower dividends from many banks and no share buybacks. The last thing is, it's not strictly regulation, but the easiest way out of this capital shortfall is to lower interest rates and change the prices of these securities. So I think at the margin, the capital shortfall in itself does help to incentivize lower rates in the US. Another thing would be lower credit growth. So particularly sectors like commercial real estate will feel this. So regional banks account for about 40% of credit creation in the US. In some sectors, it's even higher. So it's over 50% of commercial and industrial loans are small regional banks, and about 80% of commercial real estate loans. So this will impact the real economy and credit growth. In commercial real estate, this is a sector that's already under a lot of stress. We know that office property vacancies are high. We know that many holders of office properties are walking away and handing back the keys, which is putting stress on commercial property funding markets. So, that sector in particular is really looking like having a severe credit and funding issue going forward, at the same time as we see lower valuations. Probably the last one and the most important one for the banks themselves as an outcome is a lower net interest margin. So these securities are broadly held across the system. It is much worse in certain banks and much better in other banks. However, we think the duration on the average mortgage-backed security has increased from, let's call it 3.5 years at zero interest rates up to perhaps 7 or 8 years at current interest rates, because who is going to refinance their 30-year mortgage at 7% when they're paying 3% or 4%? So this portion of the bank's balance sheet that is held in these securities is going to have this low interest rate for an extended period of time. And as we see liquidity leave the system, banks will have to compete more aggressively for deposits and pay up higher interest rates. And at the same time, the banks that are heavily exposed to fixed rate long duration assets on their balance sheet won't be able to pass on those higher costs of deposits to their borrowers who have already locked in their rate. So the profitability in the system is going to be impacted significantly. This is a multi-year impact. Again, one that can really only be reduced via lower interest rates. And so we see several banks potentially in trouble for an extended period of time from a profitability viewpoint.
So really it is, the key risks, just to summarise all of that is, certainly what stood out for me was the risk of a credit crunch and what that means for economic activity. And as you called out, James, certain pockets of the economy are very exposed. And then that issue that you touched on finally, which much more broadly is the implication for profitability of US financials, and in particular the regional banks. Now, as you just touched on, there are going to be other banks sitting on large unrealised losses in their bond portfolios, in a similar way that what we saw with Silicon Valley Bank. Where do you see the biggest risks?
Yep. So look, the first thing to probably keep in mind is that there are a number of banks that have sufficient liquidity, sticky deposit bases, strong core transactional relationships. And so certain deposits will leave the system for cash management accounts, money market accounts, etc. The majority of what moves from weaker banks will move to other banks. And so the most likely banks here are the money centre banks, JP Morgan, Bank of America, Wells Fargo and Citi. So let's call these your relative winners. They're going to see more lower cost funding come in. So we don't see large risks there, even though there are some, let's call it mark-to-market losses for those banks. On the regional side, First Republic's received a lot of attention. We think unrealised losses there equate to more than 15% of the face value of the bonds they're holding, and almost 2/3 of their deposits are from corporates. So as a result, they have, let's call it, flighty deposits that can leave quickly. So we've seen that bank come under a lot of pressure, and there's several banks in that group. Another bank that we think is interesting is definitely Charles Schwab. Charles Schwab are, let's call it, similar to CommSec in the United States, one of the leading retail stockbrokers. What Charles Schwab does in terms of how it makes its profits is a bit different. So they don't have any trading fees in the US, so transactions are free, and the business model is predicated off making some fees on payment for order flow there, but the large majority of its profitability comes from essentially offering clients, at the moment, 45 basis points on a deposit on their excess cash, and then going and investing that in a range of interest-bearing securities. What they have done, unfortunately, for themselves is they've bought a significant amount of long-duration mortgage-backed securities, where these are 30-year mortgages where effectively the borrower has no incentive to replace their 3% mortgage with something at market, which might be more like 5% or above. So we expect those mortgages will be enforced for a long period of time. They're holding those securities at a couple of % interest rate. And so that really impairs their ability to pay higher interest rates on their deposits. For example, some of their significant competitors like Fidelity, Vanguard, Interactive Brokers, Robinhood, etc., all offer in excess of 4% on deposits at the moment available today, or on sweeps to money market accounts. And if Schwab was to lose those deposits, they may need to they may consider selling bonds at a lower rate. Now, the Fed has come in and somewhat backstopped those, but they haven't changed the interest rate. So if those mortgage-backed securities are, let's call it 2%, and they need to pay 4% on a decent portion of their deposits, obviously their net interest margins can get quite pressured quite quickly. So again, it's another one where we think a slight change in account holder behaviour could cause some challenges going forward for that bank in particular, that bank's profitability. So there's different elements of pain in different parts of the sector. In the sector, there's some relative winners who may still find it harder regardless, like those major banks, but let's call them relative winners. And there's some outright losers that we can spot going forward as well.
So I think it's fair to say that we haven't seen the end of the implications of what's unravelled at Silicon Valley Bank. Now, let's look at the European banking system. With UBS's recent forced takeover of Credit Suisse, is Europe going down a similar path to the US?
Yeah, look, we think there's a very specific issue on the asset liability mismatch. And we've been underweight US banks for an extended period now based on this mismatch. And whilst we're underweight banks globally as well, we are overweight European banks. And so we think that Europe definitely is not the same structure. So first of all, there's less money market funds. So when money leaves a European bank, it tends to leave for another bank. It tends not to leave the banking system. And so net, that outflow of liquidity that can force competition for deposits and deposit pricing to rise is much reduced, and the system is more stable. They also have a better asset liability match and a much larger mix of floating assets. So when they do need to pay depositors higher interest rates, as they are demanded with higher, let's call it central bank cash rates, they can reprice their loans because they are floating rate loans. And indeed, a lot of the banks that we're invested in and we look at, where they do write fixed loans, often they swap them to floating, and so they're very focused on this asset liability match. Regulators have been stricter since the 2008 crisis and since the European crisis that followed several years later. So we don't think you see the excesses in the banking system that you've seen in the US. And we also think you've seen much more conservative, to match those much more conservative lending practices, you see, higher capital levels. So two banks we've spoken about a lot, UniCredit and ING that we've held for some time. They have excess significant excess capital levels. I might talk about one of them later on if you give me a chance to give an example. But and then so yes, Credit Suisse was there, but it wasn't. It again has a deposit base of, let's call it, higher net worth individuals with larger average balances, and they'd had it's an unprofitable bank. And again, it was a crisis of confidence. So they lost 40% of their deposits in 2022, most of them in Q4, and they were seeing accelerated outflows, obviously, earlier this year post the issue in the US. And so whilst that was a pretty negative event for them, we're pretty confident that the banking issues are contained. Probably the thing that does concern us in Europe, and we've had positions here back as far as 2021, is certain activity to protect the portfolio, certain activity that's happened again in the real estate market, lending into the real estate market, a stretch for yield in that market where we've seen certain lower grade office properties trade at 3% yields and some of this behaviour. And so we have spent a lot of time trying to work out who's funded those loans, and look at the equity of the companies that receive those loans, starting probably 2 years ago.
Okay, that's interesting. So while we know there are risks in the banking system, the implications are perhaps wider than what investors realise. Now, James, I will pick up that little breadcrumb you dropped for me in the last answer. We have seen a big dislocation in European and US financials. Is this a buying opportunity?
Look, not in US banks. Very happy to generally stay away, stay underweight. I think if you did want to own anything at the moment, you'd look to the money centre banks that are going to see inflows. I think that will be structural. I think it will be multi-year. That this impacts, corporate confidence. It might be the retail deposits might prove a bit stickier for the smaller banks. And probably the other area that's interesting is banks with wider net interest margins, naturally wider net interest margins. So less sensitivity. So think about things like credit card loans, auto portfolios and that type of thing that you would be naturally very, very cautious of because of, let's call it, credit risk in the current environment. But where the asset liability mismatch doesn't occur, and you've seen those banks still take a hit in terms of their share price recently. The analogy here is, again, back to the capital positions. Is Europe around 2013? I mean, it took 7 or 8 years until a lot of the sector as a whole was able to start paying a decent dividend, returning capital, buying back shares. And so, yes, those larger banks may be able to outgrow the system, but I think we're headed for a period of capital rebuild, and we're headed for a period of lower net interest margins. So the preference still remains in developed markets for, let's call it, European and UK banks. We also hold a few banking positions in emerging markets. We would say emerging markets excluding China, that we're interested in as well. Just to give you an idea about UniCredit, it has a capital ratio of 16%, and this is basically, the risk-weighted equity to loans is a simplified way to think about that number. That's probably double on a mark-to-market basis where the US system's at. It's got about 30% of market cap in excess capital, of which 2/3 will be distributed to shareholders this year, and they've basically wound up their bad bank. Double-digit ROE is now starting to come through. Very low price to book, 0.5, 0.6. And we think in the next 4 years we're going to see 80% of the market cap of the company just redistributed back to us as shareholders in the forms of dividends and buybacks.
Now, something you called out earlier in this interview was that the easiest solution is lowering interest rates. The Fed and policymakers in the developed world more broadly have been on a pathway of tightening to bring inflation under control. And so the Fed is faced with a very difficult dilemma, focus on inflation or financial market stability. And look, on the one hand, the Fed's decision to provide additional liquidity to the system in that initial aftermath of Silicon Valley's collapse is quasi-QE. But on the other hand, we've just had the Fed recently hike policy rates another 25 basis points. So what do you think recent events will mean for Fed policy?
Yeah, look, I think it certainly means we're closer to a peak, if not at the peak of the tightening cycle. Conditions have been tight for a while now, but you see bank failures, and I think that does tighten conditions further. Not ignoring the recent rate rise, but we're definitely near the end, and the bond market is suggesting that money supply has already started to contract. On a 6-month basis, it's starting to be meaningful. It's the first contraction in the 60-year history of the money supply series. So, credit conditions, liquidity conditions in the US have tightened significantly. Let's call it prior to the bank failures. Keep in mind, it was only a year ago short-term rates were close to 0, and now they're 5%. And so monetary policy works with a lag, and that lag, depending on what part of the economy you're in, typically it'll be 9 to 18 months. So we expect the full impact of these rises to be felt by the end of this year. And we're seeing stresses, so credit spreads are rising, repricing in bonds of banks, tighter lending standards from banks. And so that's really the market doing some extra work for the Fed and cooling the economy. In terms of the ECB, we recently saw a 50-point hike. They're further behind the curve than the Fed in terms of the inflation fighting. So we think there's probably a little bit further to go, but like the Fed, they'll be very sensitive to the extent that there are any shocks in the banking sector, or the rate rises continue to impact consumer confidence or business confidence. And so we think that we're in a contractionary environment in terms of we're set up well to have a contractionary environment in terms of the economy. That does usually reduce inflation risks, and so all that adds up to potentially, let's call it, lower profits and those types of things, but also lower rates.
James, thank you so much for your insights on what is a very uncertain time in global markets.
Thanks, Alison.
We'll have an update on our broader portfolio positioning in our next episode. So don't forget to subscribe to this podcast so you can get an alert when the episode is released in a few weeks' time. For further information on Antipodes, head to our website, antipodes.com, and you can also follow us on LinkedIn and Twitter.
Please remember, this content is general information only. It is not advice of any kind and doesn't take into account your personal financial situation, objectives, or needs. You should seek professional advice before making any financial decisions. Individual stock commentary is illustrative only and not a recommendation to buy or sell any security.